Welcome back. It's time now for Hot Picks. My next guest expects Airbus to have high single-digit annual revenue and earnings growth through 2030. That's one of his top picks in the industrial sector. Joining me is Michael Landsberg, Chief Investment Officer at Landsberg, Bennett Private Wealth Management. Michael, thanks a lot for joining us. Let's just take a step back and begin with what you look for in an industrial stock before you recommend it as a buy or buy it on behalf of clients.
Well, Paul, what we look for realistically is earnings growth. That's really what we think ultimately drives every stock that we're going to own, whether it's industrial, a tech, or whatever. And all these companies seem to have obviously good earnings growth. But we also look for visibility, something that we're going to be able to own for 1, 3, 5 years down the road. That's the intention when we buy something, where we've got some visibility, the ability to model something going forward. And obviously, those are some things that these three in particular, we've owned for a while. We continue to own them.
Okay, let's get to Airbus. As we told viewers in our introduction, that's your top pick. It is the French maker of aircraft. Why do you like Airbus?
A couple of reasons. First of all, their major competitor is Boeing, and Boeing just seems to be going nowhere quickly. I mean, if you look at the stocks in the last 7 years, Boeing's flat for 7 years. Airbus stock price is up 150%. So the momentum is clearly going in the Airbus way. They don't have any of the manufacturing kind of bottlenecks that Boeing seems to have. And the other thing that we like about it is they do have 20% of their business is defense. So it's a little bit of a diversification. They've got the better quality commercial product that people are looking for. So right now, I think also with the kind of the status in the world, there is a push for European companies to do business with European companies, maybe skewing away from some American companies, and Airbus would be a big benefactor of that.
Okay, number 2 is Trane Technologies. It is a HVAC specialist.
Yeah, it's one of those. It's kind of the dominant player in HVAC. And HVAC used to be a very boring business. It was, hey, we install some air conditioning, that we'll get paid on the front end of that. Then we'll service it. We'll get paid on that. But the data center business with AI, I think is going to be a game changer for them. They're getting construction. They're kind of basically backloaded here to try to get as much done as they can. And we think data center construction is going to go on globally for the next 3 to 5 to 7 years. Not only are they going to build it and install it, they're going to have service contracts on back of that. So we think that's a strong story for the next, again, 3 to 5 years. We've owned it for a couple. We anticipate owning it for a few more.
The estimated PE multiple on this stock, that's the PE multiple on expected future earnings, is about 33 times. How does that, how should we think about a multiple of that magnitude for an industrial stock?
Yeah, I mean, what we've got now is kind of like your parents' industrials and kind of our industrials now. There's almost a new paradigm now with these industrials that have exposure to artificial intelligence and some of the things that are going there. The growth rates are going to be much faster than we're used to. You're even seeing that in utility space, which is another space that we like a lot. You're going to have your kind of your parents' and grandparents' utilities and kind of this generation's utilities. I think that kind of speaks to some of the AI exposure that some of these industrials have. I think that's going to drive it. Yeah, it's a little bit pricey, but as it continues to make new highs, we continue to say, yeah, it's going to look pretty cheap in a couple of years as it continues higher.
Okay, and the third stock is one of those GE stocks that were created from the breakup of GE Verona. The stock has soared over the past 52 weeks, going from about 155 or so US dollars per share to 524. We're seeing 526 on our screen right now. It's up 200% over the past year, and that doesn't deter you. You like this stock at these levels.
Well, we thought there was value here. We were waiting for a long time for GE to split some of these companies up. We knew the conglomerate was worth a lot less than some of the sum of the parts. The stock has certainly moved, and we look at it as it's something that we bought roughly a year ago with the idea we're going to hold it for 3 to 5 years. Power is, again, a scenario where there's just not going to be enough of it. And we're going to see, issues, and we're seeing that within kind of the hyperscalers where they're buying additional, energy to be able to get themselves. We think that's going to continue here. GE Vernova seems to be one of the few companies that can make power, which we think there's a scenario. It wouldn't necessarily be one for somebody who doesn't own it, I would run and buy it today. But it's certainly one that if you don't own it, I'd look to have it on a list. If you get a pullback in July or August, I certainly would would look to add it to a list. We really like the stock longer term. Continue, I think, as it gets more and more focused outside the U.S. Right now, it's pretty much a U.S. play. That's where a lot of the data center construction is. But it wouldn't surprise me to see them start to do a little bit more business over in Europe and into Canada as well.
And what kind of valuation metrics do you use to assess this one? This one is trading, we just talked about Train at 33 times expected earnings. This one is trading at close to 75 times expected earnings.
Yeah, and that's, again, what we're looking at when we model out a company that's got this kind of growth rate. You've got to look out for really the time frame we're going to hold it. So if I'm looking at a 3 to 5 year holding, what's the earnings going to be in a few years? Because if they're growing 75%, 80% in earnings, that multiple's not going to look that crazy. So in a PE to growth ratio, it's not as crazy as the 75 PE sounds to somebody that's saying, I want to buy a kind of a stodgy industrial. This is certainly not a stodgy industrial, but it's also growing in multiples more than any stodgy industrial does. So we look at it from a holding time. We say, okay, if we're going to hold this for 3 to 5 years, what do the earnings look like at that point from a modeling standpoint? We look for it today and say, okay, can we justify purchasing it based on that? Obviously today, having been up nearly 200% in the last 12 months, yeah, it's a little harder for me to say for new money, buy it today. But if I do get that dip and I look out at 28 and 29 where we project things to be going, yeah, I think it's attractive here. Again, I'd like it 10 or 20% less for a new buyer. But for existing clients, certainly we're going to hold it. And if we get an opportunity, we would add to it on a dip.